Bond yields often appear in the news, but what do they actually tell us about the economy and your money? A bond yield is essentially the return an investor expects to receive if they hold a bond until it matures. The most important concept to grasp is the seesaw relationship between price and yield. They always move in opposite directions. Several factors influence these numbers, including how the central bank adjusts interest rates and how much inflation investors expect in the future. Don't confuse the coupon rate with the yield. The coupon is the fixed interest payment, while the yield reflects current market conditions. This graph shows how yields move over time as investors react to new economic data and changing market sentiment. Think of the yield as the price you are paid for waiting. Higher yields suggest the market expects higher returns elsewhere. Understanding yields helps you see the bigger picture. Thanks for watching, and remember to keep learning about how markets work.